This is an election year, which means that the media is full of stories about how one political outcome or another would be a disaster for the country and potentially even introduce a whole new level of risk to investment portfolios. No matter the year and no matter the candidates, the same dialogue tends to repeat itself, which is remarkable when you consider that investment markets have historically tended to be rather politically indifferent. It's not that politics are irrelevant, it's just that other factors such as inflation, economic growth rates, the Fed, and corporate profits, as examples, have historically proven to be much more impactful. That said, most investors do crave stability and certainty and thus tend to be apprehensive when it comes to any disruptive political change that could lead to changes in the tax, regulatory, or economic environment. Perhaps as a result, history suggests that markets actually perform best when the president is fairly unpopular and Congress is so ineffectual that it cannot pass any disruptive legislation that would increase market uncertainty and potentially even make things worse. The current powerful bull market in equity supports that perspective, as it's hard to imagine a much more contentious political environment than the present. Meanwhile, Trump and Biden have, according to Gallup polling, actually tied each other as the least popular presidents since at least 1960, with average job approval ratings of only 41%. It's possible that equity markets have actually benefited from this lack of support, as unpopular presidencies have historically been associated with higher equity market returns. In fact, the Standard & Poor's 500 index has historically produced its best returns when the sitting president has approval ratings of between 35% and 50%. Our premise is that the markets don't want the economic and social environment to be so poor that they justify approval ratings below 35%, but they also don't want a popular president with approval ratings above 50% who has the political capital to get things done, thus creating uncertainty and the potential for change. If you buy our premise that markets celebrate ineffective and polarized government, then you'll not be surprised to hear that the stock market has actually performed better under divided government than under single-party rule, where the same party controls both the White House and both branches of Congress. So what does history suggest about the impact of party politics on the stock market? According to data from Morningstar, $10,000 invested in U.S. large-cap equities from 1961 through 2023, but only invested during Republican presidencies, would have grown dramatically to over $102,000. To the surprise of many, the same sum invested only during Democratic presidencies would have grown to over $500,000. However, to draw the conclusion that one should invest according to what parties in the White House would miss the point entirely, as that $10,000 would have grown to an excess of $5 million if the investor had simply ignored politics and remained fully invested. As such, while the past is no guarantee of the future, the lesson from history is that investors should at least consider ignoring the political noise and simply remaining invested, or at least not modifying their portfolio allocation for purely political reasons. Thank you very much. Take care.